All right. Thanks for joining. Happy March. We have a new background. It's a new month. March 2nd, 2016. Let's go ahead and get started.
Welcome to the show, it's Mortgage Talk. Grab a coffee, sit, and let's unlock the dreams you've got, the place you crave. From the front porch swing to the hidden cave. Talk about your home, talk about your plan, talk about the future where you'll stand. Your mortgage, your dream, your story to give. Let's talk about the place where you wanna live. Got questions? Here's the place to be. A TikTok Live Mortgage Jubilee. Fix or float, we'll break it down. From city lights to your small town.
Thank you for joining. My name again is Kenny Murden. I say let's see. Oh, you have an intro song? Yeah. I like AI, so I play around with AI a lot, and so I wrote a little jingle. I also have an outro that I'm working on and making it a little bit more, polished, because I do repurpose these videos onto other platforms, and including the full length hour. I repost them on YouTube, which is Mortgage Talk with Kenny. So if you want, you can look at the full hour, but I mean, they're pretty repetitive, because on the TikTok platform, a lot of times people kind of come in and out. And so I'm able to address any questions that people have on the fly. But again, to introduce myself, my name is Kenny Murden. I'm newer to TikTok, got started on here last October, I believe, somewhere around there. And I have been lending since 1999, so not newer to lending. In that time, I have been a fantastic resource for real estate agents and loan officers alike to kind of solve some of their more complex issues that they have when they're trying to structure deals that, they maybe want just a second pair of eyes on it to get another perspective. And I'm happy to do that. That's made me also very capable to answer any questions that you might have about real estate in general, about mortgages. And as I always like to kind of get into pricing, that's typically is more, front of mind questions that people have about pricing. So if we take a look at what interest rates are doing here, responding to the whole war in Iran and all the, chaos. I don't really follow the news. I don't really get into the politics of things here, although I'm anti-war in general, so I'm not a big fan. Last Friday, we saw rates kind of come down dramatically. And now today looks like they're spiking right back up. That's a really big change that we're seeing on the 10-year yield, which is what interest rates tend to follow. So I do follow financial news. I don't follow the rest, to kind of give you a background on me and how I am looking out for the best interest of you, the consumer. And today is going to maybe be a little bit different, as I'll be on here. It might be a little bit of a watch me work kind of a day, because I do have some loans that are stacked up and need my attention. And so I might do a little bit of, multi-purpose, is I've been kind of scrolling through TikTok as well, looking at other creators, what they're doing in the mortgage space. And I don't want to use the word boring, but when I was going through a few people, they were just kind of sitting there, not really presenting anything. So that's not really my style, as I like to get started here on pricing. I price out an FHA loan with a 680 credit score here in Texas, $400,000 purchase. And the reason why I'm taking these numbers is because this is a very common loan type that I come across. And this way I'm able to price out and see what interest rates are doing, if they're going higher, lower, and then we can kind of talk about what that means, if there's an opportunity for us to take advantage. So looks like we have other lenders coming up to compete with the top lender that is, they've been just priced fantastic for quite a while now. Well, let's take a look at 5 1/8, and I'm looking at the point, so the cost to get the rate, and so yeah, they're still pretty aggressive. So we're less than 1/2 of a point. Again, a point is 1% of the loan amount. So if we're looking at a $400,000 loan, half of 400,000 would be 200,000, and then move the decimal over would be $2,000 in lender cost to get a 5.125 interest rate for an FHA loan, which is fantastic. I don't think it'll take long before we see the 4s. And as we talked about last week about a new program that's going to be coming out that's going to lower the rate for conventional loans with an equity share component to it. I just kind of teased on that a little bit last week. We'll get more into it once I have it actually on the shelf, ready to deliver for you guys. And I'll get into all the details. We'll get into the weeds on that program. That's going to be a huge thing that is going to save people a lot of money, especially if you're somebody that's just looking to, this is your permanent move, right? You're going to be making a long-term stay where you're at. Now, if you're unsure, like on this, you need to move, and you're not thinking longer than a few years, I'm not like some of the other folks that say you always need to own versus rent. I don't think homes are going to appreciate as much in the next 10 years as they did in the prior 10 years. So that the reason why that's important when comparing renting to owning is you don't want to get stuck with the cost of having to sell a house unexpectedly. And so a lot of people don't know what those costs are to sell a house. So I would plan on about a 6% cost. So the house would need to appreciate that 6% in order for you to break even. Otherwise, it's a hidden cost when it comes to owning a house, where you're thinking if I buy it for $100,000 and it goes up to $110,000, I gained $10,000. That's not the case. You gained $4,000 because it's going to cost you $6,000 to sell it. So I want you to keep that in mind when you are thinking about buying versus renting, and very happy to have that conversation as well. The pricing that I did here above, this is just the kind of every day I start the show with this one scenario for an FHA loan. But if you have something that you want to get priced out, feel free to throw your situation into the comments, and we can price out your loan live here on TikTok without having to go through a full loan application, just kind of give you rough numbers. If you want something that's more detailed and more accurate for your situation, go ahead and screenshot this, call or text the phone number at the top, and I'll be able to get you a loan application. Takes like 5 minutes to fill out. I request some documents. I'll just email you a list of documents that I'll need, and we can get you a pre-approval letter same day. We can get you, a full quote, written quote of all the interest rates, APR, costs, all of that good stuff. So if you want just something quick and easy right now, shout it out. Happy to price it out for you. Otherwise, feel free to reach out. Or if you just have any questions in general about buying or refinancing, if you have a situation where it's like, oh, this happened, is this something that, that would be a problem moving forward? Or is it something that is something we can overcome? For example, I have a situation right now where somebody had some recent late payments, and The computer, the automated system said no, it's a no-go, right? So it basically looks like a denial. But the underlying components of the rest of the file, the credit score, the amount of down payment, different factors that we're looking at, we're going to be able to do a manual underwrite. So even when the computer system says no, it's denied, we're going to be able to challenge that and overcome that by going to a manual underwrite and being able to get them the same good pricing that their credit score allows for, with no additional cost to do that. So it takes maybe just a little bit more time, maybe a little bit more documentation. I'm going to be helping her write a letter of explanation to share with the underwriter the different life events that happened where there was hospitalization due to an illness and a job change. That was the reason for the late payment. Once that's detailed out to the underwriter, the loan approves, and everybody goes about their way as though it approved, without the whole computer kicking it out, right? That component where most of the stuff that is done in underwriting is computerized. It's basically yes or no, pass or fail. Pretty rigid. And I mention this a lot to folks where it's like, think about underwriting as though you're talking to a computer. It's not like, It's a Wonderful Life. If you're familiar with the movie in Bedford Falls, where they're talking about kind of the character of the person, getting to know somebody on a relational business level. That's not the way it works in current state of things. They're looking at credit score. They're looking at the component that builds into that credit score. How many accounts do you have open? What's the utilization? Are there any late payments? Those kinds of things are more important than, if you're a good guy or a good gal. And so I know kind of the hurdles and the loopholes to be able to help guide you through to an approval. And like I said, on this loan that I'm submitting right now, I'm also helping her with a letter of explanation. And that's very common. I've written, hundreds of letters of explanation over the years to help my applicants get their loans approved. And so that's a good thing to recognize. What does a mortgage broker do? We are commission-based employees, and so we only get paid if the loan closes, right? So it's in our best interest to help it approve. And so I always, let my applicant know at the beginning, the more information, the less surprises that I have throughout the process, the better I understand where you're at, the easier it is for me to get you to the finish line. And also, there really is no hiding anything. Underwriting is pretty thorough. So if they would have something that would hang us up, it's better to fully disclose that up front rather than having to, backtrack with a live application with maybe a live purchase agreement when there's real money on the line. So I would say, even if you have something that might be a little bit unflattering in the past, it's important to address those things up front. And, when you're dealing with a collateralized loan, it's pretty forgiving. It's pretty forgiving to be able to, buy something where, if you think about it, let's say you're putting, a down payment of maybe 5% or whatever. So if you're the lender and somebody's giving you a 5% discount on this house, and if they don't make the payments, you get the house back as the lender, but you got it back at a 5% discount, right? Because somebody else covered the down payment. So that's kind of the way to think about it on the security if I was the lender. The other thing important to think about there is, what is mortgage insurance? So mortgage insurance covers the cost of a foreclosure proceeding and all that kind of stuff if you were the lender, right? So they are protected. The more protected they feel, the less risk they have. the more likely they're going to make the loan and release the funds, so you're able to purchase the real estate that your objective is to do. And then also on the subject of mortgage insurance, it was reduced recently for FHA. I think, what was that, like 2 or 3 years ago? All my days blend together now, so are my years. But it was not too long ago they reduced the cost of mortgage insurance for FHA. Let's see, the question was thoughts on HEI. I'm not sure. I don't know if you were starting to write HELOC, home equity line of credit, or HELoan, but I don't know. I'll look up HEI. Home equity investment, home equity sharing agreement. So we have a new loan program that's going to be coming out that's for primary, so like your owner occupied place with some equity sharing. So here's my honest take on equity sharing. I'll just kind of like put that as just kind of an overarching thing to your question. I'm becoming more of a fan of equity sharing to lower the cost of holding the real estate. Here's why. And let me preface that by saying that I don't share well with others. And so I would typically not want to have too many chefs in the kitchen. Personal preference, right? But what I had said earlier, it's still true. I personally, my opinion is that homes will not appreciate in the next 10 years as much as they did in the last 10 years. And for that reason, just on a pure math basis, equity sharing is not as scary to me, because now I'm shifting my focus away from real estate being, the thing that's going to grow my portfolio in the next 10 years. I'm shifting my focus to other asset classes. And so that's another thing that I talk about on this channel, where if I'm able to help somebody with a debt consolidation refinance, save them $500, $1,000, $2,000 a month on their budget, rather than taking that extra money and plowing it back into the loan so they can own that real estate faster, my personal preference is to take that extra money that they have in their budget and invest it in a different asset class. Personal opinion, not financial advice. It's where a company gives you money without monthly payments for 30 years or more or less. Then you have to pay back or sell your home. It's based on the equity of your home. Yeah, so again, equity sharing, I'm becoming more of a fan of it for that reason. So hopefully that answers the question there. Next question is, how do loan officers not like using 1099 for proof of income? Or why do loan officers not like using 1099 for proof of income? It's not that they don't like it. Well, some will prefer W-2 to 1099 because it's easier math, and maybe math is tricky. I don't know. But it's not like they don't like to use 1099. What ends up happening if you're 1099, then what they want to see is the 1099 plus the tax return to see what was written off against that income. Because then we want to look at, the gross income minus expenses. And a 1099 does not show the expenses. So that's the question that the underwriter is driving for. Now, with the advances of technology, it's becoming super easy. I was doing it longhand for years and years, but now with technology, it's becoming easier and easier to get, more loan officers comfortable with that. But let's say in the example, there's a ton of expenses against the 1099. You're still able to use most of a 1099 income on a non-QM or a non-qualified mortgage loan program where you only use the 1099 and you don't have to show the expenses. There is an adjustment for interest rate on that and some of the costs that associated with it. But there are loan programs that are 1099 only. And there's a lot of different alternative income loan programs like bank statements as income, where they only look at the deposits that are put into the bank statement. That would be including if you have multiple sources of income, as I do, as a lot of different people do. Let's say you have, a home that you're renting out. Let's say you're getting some investment income. Let's say you work a job. Maybe you sell some stuff on freaking eBay or Facebook Marketplace. Whatever gets deposited into your account, they're able to take a look at that. They're going to throw out anything that's like too large or abnormal. But for the most part, they're going to add up everything that's deposited into your account over the last year or 2 years. And then they also subtract a percentage to factor in for expenses if you're self-employed. So they call it an expense ratio. So there's a lot of different ways. And actually another loan program that I used to talk about quite a bit on here is there's actually a loan program that requires no income whatsoever, including buying a primary residence. So if you have really difficult income to prove to underwriting, when I say that there are alternative ways, I mean, it's literally, income is not an issue as long as you have enough down payment and good enough credit. And one thing that I haven't talked much about on here as of late, but I used to, is there's the three-legged stool. So you have your income, your down payment, and your credit. Those are the three things that go into improving a loan. You only need 2 of those things in order to qualify. So if you can't show the income, but you have good enough down payment and credit, you're good. But the same is true for any of those options of the best 2 of those 3 things. And then if you have all 3, awesome. Then you're going to have an easy approval. And like a gentleman that I have here applying, he'll probably get an appraisal waiver because he's putting 10% down and he's got, perfect credit, like 800 credit score. Let's see, 30-year fixed mortgage, conventional. What is the interest rate right now? First time home buyer. So Daniel, let's pull it up. Thank you for the question. We'll modify this. And just so you know, we did just do an FHA option. FHA is going to have a lower interest rate. And we were looking at 5.125 costing half of a point, which is a percentage of the loan amount for the lender costs. So we did just cover that, but let's take a look at it. A conventional 30-year fixed. And I'm going to put in the assumptions that I'm going to make, but feel free to add in your details as I make those changes. So conventional, I have a $400,000 purchase, and I'm going to assume a 3% down payment. And I'm going to select the first-time home buyer. I'm going to say the credit score. All right, so you said $1 million house, 10% down. I'll make that change. And I'm going to assume very good credit. So I'm going to say 780. Now, a $900,000 base loan amount is not going to, oh, I was close, 780. I'll give you the extra 5 points in the thing here. But so I'm wondering, where is that? Because you might be in a high balance area, because I believe conventional conforming is just below 900,000. Conventional loan limits. Max to, yeah, 832. Thanks, Debt Snow, to avoid jumbo. So unless they're in a high, that's what I was thinking. Maybe they're in a high limit area. So it would make a difference knowing, your zip code, I guess. But I'll just assume 90210 because I remember the TV show. Okay, you're in New York, Queens County. Thank you. I'll update that. Let's go New York. Queens County. And we'll back this out to par, fees in, and take a look at some pricing. All right, so I'm going to modify this because we want lower closing costs. So let's take a look at 6%. So what is that? About 0.75 in points. It's a larger loan amount, so I would personally prefer to probably raise the interest rate to lower the cost. So I'm going to take a look at 6.125. And it's personal preference. If you prefer the lower interest, then you can go that way. And also, let me also mention, so yeah, this is what I would personally do in that situation. If it were me getting the loan, I would take the 6 1/8 and pay the 0.36 in loan cost. Thank you for the likes, by the way. But the other loan program to be aware of, and let me see if that county, let's see, view eligible areas, and I can bring this over to this screen so you can see what I'm doing. But if I go down to New York, I don't even see New York on here. So this loan program doesn't work for you yet. They're adding more areas, but that's the equity sharing program where they would basically take that 6.125 and make it 4.625. Not available in Queens County yet. And it's per county. It's a nationwide program. And they're adding more places as we go along. And in full disclosure, I'm not licensed in New York. One of my team members is. So I would have you working with her if you wanted to work with us, just in full disclosure. First-time homebuyer options in Texas. Yeah, we have a ton of them. I know we just they came out with the new, what was like Dream, what was that program? I don't think it was T-Shack. I think it was something else here in Texas for the first-time homebuyer program. But one thing, yeah, appreciate you, Daniel. Thank you very much. And again, if you want to reach out, I can put you in touch with my team member in New York. Let's see. I just got a neat. Oh, sweet. Just got a neat message on my text message. Thank you. So yeah, feel free to text me if you want to connect. But is it Randa 3 talking about first-time homebuyer programs here in Texas? I've not seen more down payment assistance programs in my life than I have in the last year or so. And there are a lot of programs where you can put very little money down. Now, obviously, the less money you put down, the more expensive your monthly payment will be, right? So there's a little offsetting there. And sometimes it makes sense to put a little bit of down payment. Like 3% down gets you a much lower monthly payment than if you go with no money down. But if you don't have the funds to put down, those programs exist, and you can also always refinance later if the payment is a little bit higher. So sometimes when I'm working with first-time home buyers that don't have the funds to, put the money down, let me also say this real quick, because this is very important. For a first-time home buyer, if you've not owned a house before, there is no one to call a landlord to take care of an issue. You are the landlord. You're the one, owning and responsible for anything that mechanically, wears out. And so I want you very much to have some savings. So I don't want to put you in a situation to cover, a 3% down payment or whatever, if that would wipe out your savings. So I very much would rely on those down payment programs to keep that savings available just in case you need it for a water heater or something that goes out. You know, you need to have a little bit more savings as a homeowner. I mean, you can always rely on credit as well, right? You can finance a water heater or whatever, but I would very much be focused as a first-time home buyer to keep savings in mind. Was your question about pricing though? Because again, FHA we just priced out was about 5.125 with half of a point, which is half of a percentage of the loan amount. And the thing I always start the show with is because I'm in Texas, so I just do a Texas $400,000 purchase with 3.5% down, and that was 5.125 rate, costing a half of a point, which would be about $2,000 in lending costs there. And again, costs can be covered by the seller. That's very common. Especially here in Texas, it's very common for the sellers to cover the closing costs. The way that kind of ends up working, you kind of finance it in the price most of the time, like real talk. What's happening is if you have, let's say, $100,000, just for simple math, $100,000, and you're asking the seller to cover $3,000 of the cost, you end up bumping the purchase price up to 103. They cover the $3,000 in cost. So the seller nets the same. When the that you guys are just going to go back and forth on what your offer is. But if you offer $103,000 and ask for $3,000 in closing cost, and somebody else offers them $100,000 with no concession on closing cost, they're going to net the same, right? So they're going to be comparing offers. Which one do I want to go with? And you want your offer to stand out if you want that house, right? You want to have the strongest offer possible. So that's just kind of something to keep in mind, how that works when you're asking for sellers to pay for the closing cost. Nothing's free, is my point on that. But for the different pricing of the down payment assistance programs that would go over and above having the 3.5% down, I would ask that you reach out to the number above, text me, just because it requires a little bit more of a manual process for me to go through maybe 20 or so different options where I'll email the different lenders individually, and then I'll get the pricing back to you. But the base pricing, like I say, on the FHA side is in the low fives, and conventional is right around that 6 1/8, with the closing cost being around that 0.5%. Thank you very much for the follow. I appreciate that. And also, again, because newer to TikTok, I forget to mention, following, sharing, liking, all of those things. But if you do know somebody that is thinking about buying or refinancing in the next, few months or so, please do share this with them, because I get on here every day. It's a little bit random. I try to get on in the morning, and I know it's in the afternoon here in Texas. So it's been a little bit random as of lately, but I do get on every day. I then, repurpose the short forms of the video into all of my different social media. So if you follow the channel, or if you follow any of my other social medias, you'll see snippets of this. But then I've also started rebroadcasting the full forum, the full hour podcast style, I guess, on my YouTube channel, which is Mortgage Talk with Kenny. So you can, if you want to share that or revisit what we talk about here. I only just did that, I think, today. And that's why at the beginning of the show now, I'm mentioning what day it is, because I just, re-uploaded on there. So appreciate the questions. If anybody else has any questions about pricing or real estate in general or mortgages, happy to go over any of those things for you. But in addition to those factors, I also wanted to talk a little bit about the value I have to offer other professionals in the space. So if they're loan originators or if they're real estate agents, I have things that I can offer them that they might find valuable. So I would share this with them as well. And I want to talk about this in a very consumer friendly way, because this is, the consumer facing channel. I'll have other channels that I'll grow that are specific to loan officers or specific to real estate agents. But basically, if there's a real estate agent, for example, some of them don't know that they don't need a mortgage license to get paid on the mortgage side of the business. So if you know a real estate agent that's looking to increase their income, we have ways to show them how to do that. So that's a really neat, and it's a newer thing. It hasn't been around for a real long time, but we're able to hire them as a business development marketer or manager. I don't know, BDM is the acronym. And they're able to get paid on the mortgage side of the business. So that's kind of a neat thing for real estate agents. A lot of people think real estate agents make too much money. That's true for some. And too much is all relative, right? If you're doing the work, it scales really well, but most of them aren't at the top of the food chain. What refi rates are you seeing for detached condos in California? Let's take a look. So let's modify this. We'll go California. Detached condo. I'm going to assume primary residence, and I'll go to condo. I'll say not a condotel. I'll say that it is warrantable. Those are some of the assumptions that I'm making. And did you want to see conventional, FHA, VA? So I'm going to assume conventional. And you're talking about refinancing. So I'll say rate and term refinance. And I will just say 80% loan to value. So I'm assuming $1 million value, $800,000 loan amount. Feel free to correct any of those things. I'm leaving the credit score at 785, but it'll be the same. Well, let's lower it to like 740 because I think it's all the same above 740. And let's take a look. I'll back this down to par pricing and see. For the type, it says attached still, I think. Detached. Thank you. Good catch. All right. Let's submit it. Take a look. And I'm going to modify that because that's too expansive on discount points. All right, so at 5.875, you're at about 0.6. You're a little over a half of a point on the closing costs. So if you want lower cost, bump it up to 6%. And if you want higher cost, or if you want a lower rate, you obviously hire actually, you know what? Tell me, very curious on this. What county are you in? And then I want to look that up in here because there's a new program that we've been talking about. So is it San Diego County? Is that, I wouldn't know off the cuff, but I'll see if San Diego County. It's listed right on there. So your area qualifies for this equity sharing program where the lender will actually pay, like, I forget if it's 7.25 or 7.5 points to lower your rate a point and a half lower than the market rate. So if we're looking at a 6% rate, even I know we were talking about a little lower than that, but for simple math, a 6% rate would go down to 4.5. Now, if you were to sell or refinance in the first 3 years, you'd have to pay that back. But that's otherwise like think of it as a non-payable gift. And then if the house appreciates in the future, there is a calculation for how much of that equity is to be shared with the lender, but they also put a cap on it. So there's a calculator here where you can plug it in to see what the costs are. I have a frog in my throat. 1 second. It's not going away. But anyway, it shows you the cost savings. So in this particular scenario, the person would benefit $365,000 over 10 years, and then the repayable amount to the lender would be $100,000. So it says that they're benefiting $265,000 by having that lower interest. So this loan program, again, is not something that I would have liked to do because of the equity sharing component of it, where I don't prefer to partner or share, having too many chefs in the kitchen kind of a deal. But I think it's going to be a really popular thing now, just because rates are really a lot higher than they were a few years ago. Purchase prices are so extremely high. It really strikes at the heart of solving the affordability crisis and allowing especially younger people to get into homes in a way where it's cheaper than rent. I think that's a really key component. If you're able to buy a house and it's going to cost you the same amount as it would to rent it, then you'd have to look at how long am I going to live there before the house might appreciate to a level where I'll be money ahead of renting. Now, there's other components there where I prefer to own versus rent because I want to use the property any way I damn well please. I don't want permission if I can get a dog, what kind of dog I can have, etc. But that aside, if you were just looking at the numbers, then there's still kind of a break even in time where the house might appreciate more, and then you'd be able to gain equity and pay down a loan to get equity in a house versus renting. A broker sent me a loan estimate with a 5.5 par rate last Thursday, but didn't lock. Would that still be good now? So is that a 30-year fixed? Is that maybe an FHA or a VA loan? Because we did look earlier, the government loans are lower than that right now. So we'd still be able to lock you in there or lower if it's a government loan on a 30-year fixed. So I'll need a little bit. So yeah, 30-year fixed conventional. No, I'm personally not seeing it that low. I would have to charge points to get you that low. Right now we were looking at more around, I believe it was 6%, still costing a little less than half of a point. I'd have to pull that back up, but just going off of my poor short-term memory in what I've been pricing here today. All right, advantages of 20% versus 3.5 down. I want lowest rate and small monthly payments. Obviously, the more down payment, the lower the loan amount, which is going to impact your lower monthly cost. So 3.5 down, the advantage there is you're going to have the rest of the money to do my favorite thing, which is invested in a better investment than real estate. I don't say that to be pejorative to real estate. I just don't think I don't think real estate, this is personal opinion. I don't think homes are going to appreciate in the next 10 years the way they did in the last 10 years. And so I think there are other asset classes that will outperform. So I would rather invest my equity in other asset classes. And I would like to just put as little money as possible in real estate. Personal opinion, not financial advice. Let's see, I have an FHA. I did a buy down and went up $500. I'm trying to finance now. Do you think it's worth it? It depends on what your fully adjusted rate is. And here's what I mean by that. So if you have a fully adjusted rate of, let's say, 7%, even if you're paying 6% right now, it might still make sense to refinance that 6% rate if it's going to go up to 7 next year. Here's why. Your buy down is just simply taking money out of an escrow account to make the payment with you at the fully, at the full 7% rate. What happens to that money if you refinance it? It gets credited back to you. So you could be money ahead by refinancing that with a recent buy down. Let's talk about that. Let's do the math on that. That's not something that I can do really quick here live on TikTok. So screenshot this, text me the number above. We'll get the math done on that one. I'm a first-time home buyer looking for a house. What things should I consider before buying one? Obviously, the first thing is location. Like, are you a remote worker? How close are you to work? Personally, I hate being stuck in traffic and wasting an extra hour both to and from my job that I'm not getting paid for. That made me a very poor employee. There's just me, my DNA. I can't be hourly and do that. Some of the other things to consider, is it in a county where we can get this below, first time home buyer. So that loan program requires a down payment. There's so many down payment assistance programs. And I would leverage that because I want you as a new homeowner to have savings. That's a very important thing because if you're renting, you can call a landlord if something breaks. If you own, you're the landlord. It breaks, you fix it, or it just stays broken. I was 9 in 1999. That's when I got started. Yes, I'm very old. I wear a hat to hide the bald spot. Let's see. Do you think it's worth it to buy down the rate? How far can you buy it down? So the answer is sometimes, right? So it's not always a good idea to buy the interest rate down, but this new program where there's some equity sharing and they pay over 7 points to buy the rate down 1.5 points on a permanent buy down, not temporary, but for the life of the loan, it stays 1.5% lower. That is a really good option to consider. And we're going to be talking more and more about that on the channel here. I'm looking for $15,000 for an as-is family home. How do I get approved for that little amount? Des, I'm trying to understand your question. Is the entire purchase of the house $15,000? Because if it is, there are credit cards that will cover that. So I would literally apply for a credit card. I have credit cards that, have a much higher balance than that, where I would just be able to buy the house without effectively a down payment. But if you are just looking for an extra $15,000 to buy something else, another thing that comes to mind is a home equity line of credit if you have something else to attach that to. But yeah, if you're looking to literally finance a $15,000 purchase, personal finance, I believe our minimum loan amount is like $75,000. So that's what I would do. Otherwise, talk to a local bank or a credit union. They might look at a personal loan. They might look at a secured loan for something that small. Elizabeth, you're very welcome. Thank you for commenting. What do I think about balloons? I heard it helps put down monthly payments. I don't know, loans that have balloons, which mean, let's say it balloons in 2 or 3 years, means you have to pay it off in full. That adds anxiety to having to figure out your exit strategy to pay that off. So if you have that anxiety, you'd want to get a benefit to offset the anxiety. So depending on the situation, obviously it'll make sense in certain circumstances. There are a lot of times where I've written loans that have balloons. They made sense. But typically it's going to be a short-term loan. Let's say a fix and hold or a fix and flip type of a loan where you're going to fix it up temporarily. Now it's going to be worth way more, and you're able to refinance those loan terms into a new permanent loan. That would be a good example of where a balloon makes a lot of sense. How much should we have left in our savings after closing? As much as possible. I know the standard thing is like you want 6 months reserves. I'm personally fine with like 2 or 3 months of my reserves, and then I throw as much as I can into my investments. So as long as you're looking at investments that are more like income producing instead of having to just put it in there and hope it goes up and you would have to sell it to get money back. Again, this is not financial advice. It's just my personal opinion. But the things that I invest in, I purposely look at things that are going to be paying me usable cash. So that's why I can get by with a little less savings. Des says, no, 30,000. So 30,000 is the total purchase, and you have 15,000. You just need $15,000 more. I would still be looking at a personal finance situation there, where you're going to look at places that are like Capital One or American Express, or like I would personally I would look at those places to get a small loan that way. You could actually, let me back that up. I could personally do a home equity line of credit on that deal, because you have so much equity in it, and the loan size isn't going to really impact anything, because there's a lot less cost. Because there are finance charges, and there's limits to the percentages that those finance charges can be. And so that's why mortgages tend to have a larger minimum loan size. But I would be able to do that on a home equity line of credit. I still think it might be cheaper to do a credit card. So I would personally, that's probably the way I would go with it. And there's ways to be able to do that. You'd want to find a title company that would take a credit card. That would be an important thing to note. So I'm not sure where in the world you are, but I would say it's pretty easy to find a title company. Call them up and ask them, if I'm buying a $30,000 property and I want to finance $15,000 of it, would you accept a credit card swipe as a form of payment? They might add a charge to it. And if that's the case, then let's consider the home equity line of credit instead. Compare the cost and go with the cost that is the least amount of cost. And I know there's other websites that will literally they'll accept the swipe of the card to give you cash. I don't remember what those websites are, but that's another thing you could maybe do a little research on, see what that cost is. Obviously, we're just looking for the lowest cost at the end of the day. So very good questions. I appreciate that. And actually, as I'm looking at the clock, let's do last call for any comments or questions. Appreciate all, wow, look at all the likes. Appreciate all the likes. Appreciate the follows. Appreciate the text messages that I received. And I'll be getting back to those after the live. But yeah, any comments or questions, real estate or mortgage related? I'm just about at the end of the hour here, so wanted to kind of do a last call. Otherwise, I will wrap it up. Oops, I have to. TikTok's making me prove that I'm here. Let's see. I'm here, TikTok. I'm here. There we go. I proved that I'm human and I'm here. So, otherwise, some of the things that we were talking about, in addition to, pricing things out, as I'm able to do live and answer any pricing questions that we have. We also talked a little bit about what interest rates were doing as a response to current world news. And again, I'm not interested in the actual world news. I'm only interested in the way that the financial markets are responding. And so I'm watching what happens here. This is a monster wrong move where rates are getting worse today than they were on Friday. But Friday, they were really good. Really good time to lock in last Friday. You always know in hindsight, and who knows, maybe they'll go right back down again. The advice that I get in my, my email from, just being in the business, said that they would advise floating the rate, which means not locking it today, which means they think rates are going to continue getting a little bit better in the short term. So that's the advice that I've received, and we'll just kind of go with that. Who the hell knows, right? Tomorrow is never promised. There's a strategy that I can do to lock something in now, and if rates get better, we can change which lender we're going to use. We just have to redisclose, basically e-sign some documents, wait the waiting period. So you really have to do that at least a week ahead of close. So if you're buying a house, we have to watch the clock a little bit, but if it's a refinance, it doesn't matter, right? There's no real deadline on a refinance. So we can always just wait out the mandatory waiting period if needed. That's a really good option on a refinance, which makes it a little bit bothersome of the guy that was commenting that his lender didn't lock him in. It's like, oh man, if it was a refinance, why wouldn't he just lock it in? And then, I don't know, maybe it wasn't a broker or something where they're not working with multiple lenders. I'm actually working with the largest broker, where we have almost 300 different lenders to choose from. So that's a little bit of a difference between broker versus retail. There's different forms of different pockets of money to borrow from. And I'm biased towards brokers, but I always say the answer is always sometimes. There are some things that retail can do that we can't do on the broker side. And I've seen that be convenient for people in the past. So I'm going to give credit where credit's due. On that, I don't like to, talk ill of anybody anyway. So that's just in general, personal deal there. But all right, so we did last call for comments, questions. If you know anybody that is a real estate agent and they want to make a little extra income stream, they don't need to be licensed to make money on the mortgage side of the business. So definitely share this with them. Other loan originators, I do some coaching, some mentoring to help them get more leads and close more deals. So if you know any loan originators, feel free to share this with them as well. I thank you guys so much for being here. Hope everybody's having a great start to their week and start to the new month, as we now are in a new month of March. And I hope to see you all back on here tomorrow. Where is my sign off? I forget what I have so many of these different things. I know it's not that one. I think it's called We'll go with this one. Have a great day, guys.